All right, I'm going to go ahead and turn this over to Frank Donati and get started.
Thanks, Amy. My name is Frank Donati. I lead our Denver transaction advisory practice, focusing primarily on financial due diligence and quality of earnings work. We're really excited to have you on the presentation today, M&A in an unprecedented time. We got some experts in both the tax field and in middle market M&A with GLC advisors. I'll let them do their own introductions. So going from there, Scott, do you want to kind of lead in?
Yeah, sure. So Scott Haberman, tax partner out of our Fort Collins, Colorado office. We have a pretty exciting topic today with M&A being the focus, and then also, like Frank said, we're touching on some NOL carryback considerations, as well as the latest from the PPP, the Paycheck Protection Program regime that we actually had some new updates released last night at about 10 p.m. Pacific time in the same fashion the Treasury has been doing over the last couple months. So we'll wind up with that topic at the very end. And so we're happy to answer any questions you guys have once we're done with that last topic. So go ahead, Carolyn.
Hi, thanks, Scott. I'm Carolyn Linkove. I'm in Eide Bailly's National Tax Office, and I lead the firm's M&A practice, focusing on the tax aspects of M&A, any kind of merger, reorg, acquisition, sale, or equity shift.
I'm Michael Richter with GLC. I focus on mergers and acquisition and capital raising, have so for going on 15 years. We're about four and a half years here at GLC. I focus on business services, industrials, and manufacturing.
Hi, I'm Jim Williams, Managing Director with GLC Advisors. I help lead our technology investment banking team focused on M&A and capital raising in the software, IT services, tech-enabled services, and internet sectors. So thanks to the Eide Bailly team for helping set this up. We really appreciate the invite in, and we're excited to talk about some of the trending that we're seeing in the M&A and capital raising markets, as well as we wanted to touch on a few of the elements we're seeing as it relates to capital options that are available during this COVID pandemic. And that landscape is, I think, over the last 2 months shifted dramatically. So hopefully we'll provide some insights on what's been happening over the past few months and what we see happening over the next, call it 6 to 9 months. On the next slide, just give a quick commercial for those of you who are not familiar with GLC Advisors. We are a national advisory firm. We're 40 professionals. We're 14 managing directors, 500 plus closed transactions, hundreds of billions of dollars in transaction value. And we are a diversified financial services firm. So we focus on mergers and acquisitions, which is majority recaps and full sales, capital raising, which is minority recaps, growth equity, debt capital raising. We do a lot of restructuring and distressed work, and we actually have a merchant banking function as well, where we opportunistically invest in what I would consider traditional industries. And our entire firm is vertically focused on industry. So we've got depth across every major industry, and we just brought on 3 new managing directors to help deepen our expertise in healthcare and gaming, metals and minings, and actually construction aggregates as well. And Michael and I have spent our entire careers focused on the middle market, which I think is where probably most of the folks on this webinar have spent their careers. And just for context, 60 to 70% of the work that Michael and I do and the GLC team and M&A and capital raising is with founder, owner, operators, and the rest would be with financial sponsors representing their portfolio companies. So hopefully that's some helpful context as to our point of view as we go through the next couple slides. So I'm going to cover 3 or 4 slides that are really focused on what I would consider lagging indicators of what has been fallout from this COVID pandemic. And unfortunately, these slides are a bit of doom and gloom because it has been, frankly, it's been astounding, the impact across a number of different markets. The good news is that Michael's going to spend his time talking about all the good stuff that we actually see coming out of this, relatively speaking, of course, through the back half of this year and into 2021. And while all of these charts that I'm going to go through are focused on the rear view, we're having conversations every single day with private equity firms and corporate development folks and founders and entrepreneurs that are indicating that a lot of the things that were really, really scary 2 months ago might still be scary, but less so going forward. And there's a little bit of clarity and some thawing of some things that we think are really important to get everyone back up on plane and at least moving in the right direction as it relates to our line of work in the M&A and capital raising. So this chart is really high level, and I think it tells everybody what they probably already know, which is that GDP and unemployment have been tremendously impacted through this pandemic. You can see in the top chart, these are charts from, I think it's 60 economists and their predictions back in April about what this was going to ultimately look like. And you see GDP, US GDP down 5% in Q1, and a really amazing forecast of 25% down in Q2. So just for context, UK saw their GDP contract 10% from, I think, February to April. China is projected to, I think, hit a 44-year low in their GDP growth. And in conjunction with that, the US lost 20 million jobs in March and April, which equates to an astounding 1/7 of the workforce that was employed in February. And while we've had some, I think, indications that are promising, unemployment still sits at 13%, and which is below some of the projections that we see here. But it's been really interesting watching the sector impact, where you think about that many jobs being lost. The last I looked, I think 40% of those jobs were in leisure and hospitality, 30% of those jobs were in food services, which I think, as we've lived through this, probably doesn't surprise anybody, but there are just certain sectors of the economy that have been decimated by this COVID pandemic. And for further context, unemployment was yet, I think, just under 3% before the pandemic really started impacting the unemployment rate. This is a slide on the public markets, and we've included the equity markets here, as well as some corporate yield and bond data. And I think we're all painfully aware of what's transpired over the last, call it, 120 days. Both the equity and credit markets were tremendously impacted, call it, starting in the middle of March, where everyone saw the huge drop, 40% drop or so in the S&P 500. And what's really, I think, been remarkable is that we've seen the equity markets rebound in a way that seems to be largely disconnected from broader economic reality. These charts here show the S&P down 7% from December, and the Russell 2000 down 17%. I think the S&P as of today is at hovering around 3150, which is somewhere around 5% off its December number, and I think the Russell 2000 is somewhere around 10 or 12% off, which just seems unbelievable given the amount of turmoil and disruption in the global markets. We've seen similar dynamics happening in the credit markets, which you can see below, where, call it mid-March, almost exactly the same time frame as the chart above, we see corporate bonds come under significant distress as the fear of defaults went through the roof. So the spread went from, call it, under 3% to over 5.5%. And that has clawed its way back as well, much in line with largely the equity market chart above. I think today that yield on the corporate yield is at 2.67% or thereabouts. So it's hard to make, I think for us, hard to make sense of how these particular markets have moved in relation to what seems like maybe longer term or more significant global economic impacts. This is something we continue to watch every single day, and it's hard to find a consensus opinion as to what's driving some of the disconnect, but it's very real. And we see some of this on the next slide, we wanted to put it in context as to really valuations of businesses. And so, what's been the ultimate impact? And I think the shorter answer is that it's been unpleasant. And how unpleasant it's been really depends on your particular industry. So we provided a couple of different charts here. First chart shows enterprise value to EBITDA trending, which is a very commonly used metric in mergers and acquisitions transactions. The middle chart shows you the percentage change from December to, I believe this is June 1st. And then we've got some stock performance at the bottom, which shows you stock price sort of indice change by particular industry. So the short of it is that as we look at this data generally, there's kind of a 15 to 20% drop in EBITDA multiple across all of these industries. Some industries have done better. There are bright spots out there. If you just look at the stock performance, maybe in particular, or the EBITDA multiple performance in particular around, just to contrast energy and technology, right, where oil and gas has been getting crushed, and the technology sector, when you think about the Amazons of the world, have largely been pulling up the broader equity markets. There's a huge disparity in how those industries have been impacted. So there is light out there, and technology is one sector that I think has been, well, as seen, if you look at things like Zoom and some of these technologies that are focused, and what we're doing right now, right, talking to people virtually, those businesses have done very, very, very well. And there's a number of technology companies that are drafting that dynamic, be it collaboration and communications technology or related services. The managed services market is doing very well. There are nice sectors, I think, probably within each of these particular industries, but on the whole, valuations, as you see here, this sort of 15 to 20% drop, we're seeing some correlation between this chart and these general reductions in value and what's happening in the private markets, or I guess I should say what has happened in the private markets in terms of the deals that Michael and I would work on. How are buyers, be it corporate or private equity, reacting to the COVID pandemic, and how is that impacting their viewpoints on valuations in private M&A transactions? So we are looking at this reduction in multiple really as well, it's kind of becoming known as the COVID discount, and it's manifesting itself in a couple of different ways. We've seen straight purchase price reductions, so just a reduction in the value of a deal. That is happening, although I would say that we're hearing less of that and more of a couple of other elements getting into deals. And those are things like earnouts finding their way into deals, which are thankfully looking more like short-term bridges on valuation gaps. We're finding seller paper find its way into deals, and that has a little bit to do with bridging valuation gaps. I think it has a fair amount to do with the state of the credit markets, at least over the past 90 days or so. We're also finding that structure on the equity side and using debt-like instruments is becoming more prevalent as people are trying to take some of the downside risk out of some of these transactions through things like preferred securities, participating preferreds, converts, things of that nature that might help take some of the enterprise value out of the equation and still allow them to get a deal done. That's been an interesting development. It's happening across sectors. It's happening across private equity firms. There are private equity firms that are beginning to reinvent themselves into more structured equity firms, at least in the short term. There are private equity firms that are moving towards trying to look at more distressed transactions. And I think as we just step back, it's our anticipation that this general impact evaluation, or some of these elements that we're seeing, will probably persist through 2020 and into some portion of 2021. The good news is that there are winners and losers being created in this environment, and the winners, we believe, are going to be in a position maybe to command a premium coming out of this when people get back to work and healthy companies are being brought back to market. And those businesses that are doing well now, in many respects, are probably looking at some longer term tailwinds that are going to make them not only attractive businesses to own during this pandemic, which will certainly continue into next year in some way, shape, or form, potentially further, but they're riding waves that will be 5, 10, 20-year trends. I'm thinking particularly in the technology space. And for the rest of the market, I don't think we'd anticipate valuations bouncing back expeditiously, regardless of how quickly these equity markets have come back. I think there's still going to be a disconnect between those valuations and private transactions for at least some portion of 2021. And some of that has to do with, or maybe a lot of it has to do with, just the difficulty that I think buyers and lenders are having underwriting forecasts and performance. And I think the reality is we're hearing from folks that there's just not a whole lot in the rear view in terms of historical reporting on financials through the COVID period to get really comfortable with how a business has done in order to make an informed guess as to how the business is going to perform going forward. There's not a whole lot of great visibility out of the front windshield either in terms of what things are going to look like. And there's not a whole lot of evidence that people who have reforecasted have performed against their forecasts. There's just not a lot of historical data to compare. Hey, this is what we thought COVID was going to do. This is how we reforecasted. This is how we performed, to give buyers and lenders some confidence that business owners and entrepreneurs, or even their private equity sponsors, have enough of a handle on the business to really understand what the next 6, 9 months or a year is going to look like. I think that will eventually subside as we progress through this. And I guess the other part that's certainly connected to that is valuations coming back in full force is absolutely going to be dependent on the availability of credit, and it just impacts the way that private equity firms can get deals done. Michael's going to talk a lot about this. Thankfully, we've already seen some thawing there, although I think it's probably less than what we really like to see, but it's moving in the right direction. And that is going to start to allow private equity firms to get deals done. I think it's going to allow investment bankers such as ourselves to get much more comfortable with bringing deals to market in mass. And we're viewing that as is probably a quiet, what I would consider a quiet summer. And then in August and September, we're going to expect a lot more deal volume to start coming to market in terms of new deals. So if you go to the next slide, we've taken a look at, call it the last close to 18 months of deal volume and value. And what you see is that the pandemic has caused massive disruption to volume. And May's deal volume, that's 80 or so transactions. These are deals in the middle market under $500 million in enterprise value. It's at 20% of January. And I think what you're going to see is June and July and August are probably going to be equally as low, if not lower. And part of that is, think about the deals that are getting done now. They're deals that were in market early this year. They were already talking to buyers. They were doing diligence. They had met with buyers in some way, shape, or form. Maybe they've done a virtual management presentation. But that's the long tail of activity that was in play before COVID pretty much stopped all new deal flow, and that was really in the middle of March. So there's not a whole lot of new deals in the market to get done throughout the summer period. Now, that gets back to a point that we were making earlier, which is there's going to be a bit of a pig through the python on new deal volume coming to market, I think, after Labor Day, which is going to create its own sets of different dynamics. But that is where I think we're starting to see some really positive indicators in the market in terms of, we've just gone through all this data about how things fell off a cliff. I think people have gotten through enough of managing the last 90 days to understand and shift their mindset towards looking to the future and getting back to business as usual. And Michael's going to spend the next 3 or 4 slides talking about a lot of the stuff that we're seeing and hearing from people as we have these active discussions.
Yeah, absolutely. Thanks, Jim. I would add that we're starting to get some calls of folks who have, been working through operational issues and are starting to perk their head up and say, hey, we wanted to exit before this. We lived through 08 and 09. We don't want to live through this again. So we're starting to field some of those calls. The good news is there is a ton of private equity out there. So what this is the total essentially dry powder of private equity in the US. And if you compare this to Europe, we're about twice of what the dry powder in Europe is in terms. So in the private equity world, they, 08, 09 was tough. And this chart kind of represents, they had to work through some portfolio company problems in 10, 11, and 12. And, the fundraising environment from 2013 to today has really been phenomenal. They've had great returns. The capital's out there. As Jim mentioned, we've had probably over 200 conversations with private equity funds that we regularly call on. And we also raise money for private equity funds too. So we feel like we have a really good pulse on kind of what's going on here. And, we're seeing some of those guys come to market a little bit earlier prior to this, in 17, 18, and 19. So their funds are structured over 10 years where the first 5 they invest, the second 5 or the latter half they harvest, but they're starting to go out and raise money in year 4 and 5 in their fund cycle because they've been able to put so much money out. So these guys are actively looking for deals. They all had some portfolio problems one way or the other through this. As Jim mentioned, kind of came to a screeching halt. It's picked back up. But coming out on the other side is, a lot of them aren't seeing deals, but they're trying to figure out, what does due diligence look like in this remote environment? How do we connect with the management team? Usually we sit down in person and get to know one another. We had one client who chartered a private jet. We've heard, private equity groups get in a big van and drive, 8 hours to meet a management team. Some are comfortable doing Zoom and they feel like they can get a good feel for this. So the good news is, regardless of kind of what's going on in the private or the public markets, private equity overhang, there's plenty of dry powder out here. And not all private equity is bad. Obviously, they want to partner with management teams and help management teams in lots of ways. On the next slide, so kind of the impact to our process and deal terms, as Jim mentioned, we will vividly remember the middle of March where we closed 4 deals since March 6th in our office, and 3 of them just came to a screeching halt, rightfully so. Lots of uncertainty, and as Jim mentioned, just private equity groups not having the foresight of what might happen, who was going to be deemed essential, all those types of things. So it was an interesting time. New deals through March and May, basically through the end of early May, new deal flow was off 80%, which is pretty astounding. But if you think about all that was going on, everybody was essentially putting out fires. So companies have been holding off going to market, dealing PPP loans, putting out fires of their own. But we're starting to see people get comfortable again. And in our deals, the private equity group said, hey, we 6 weeks went by or whatever, and they came back and said, gosh, we're comfortable with your business and how you perform, because we had one of our businesses was in construction services, was deemed essential, and their performance, there were hardly any hiccups through all this. So as Jim was talking about valuations, it really depends on, if your business was deemed essential, how you perform through all this. And if you can come out of this unscathed, then obviously you would demand a higher valuation on the back end. So again, private equity groups are out there, and there could be a valuation gap in terms of what we look like coming out this or on the backside of this. Jim touched a little bit on deal structures. One of the 3 deals, 3 of the 4 deals we sold were to private equity. One of which had an earnout, which is simply just moving some contingent consideration dependent on future performance. And it was about 1% of the purchase price. So, and we're having more of those conversations, but a lot of it is just more around protecting owners or sellers and acquirers in terms of, reps and warranties, what they didn't know or know as they were going through this. I know that they're going to talk a little bit about kind of the PPP loan program, but something was real for us too was, the money came out, everybody got it, and then they came out with, some guidance, and the private equity world was saying, well, gosh, maybe you had a large cash balance on your balance sheet, or maybe there was a transaction coming, and, looking back, should you have taken the money? So we've seen instances where, it's more kind of reputational risk, but we paying back the PPP loan prior to transactions. And then, what we obviously have talked to tons of private equity groups, but we're also talking in conversations with our clients, and wanted to share kind of what our, good management teams are doing. Obviously, how they're weathering the storm. One is cash is king, making sure that they understand their liquidity position, their 13-week forecast, making sure that they understand, if they have enough capital, if there's a capital need coming up down the road, but just being on top of it instead of being proactive, instead of waiting until it's too late. Over communicating, everyone's nervous. It's an uncertain time, just given the lack of data that changes every single day. So we're seeing good management teams over communicate, to their employees, customers, vendors, capital sources. This is where we are. This is where we plan to be. This is what our capital position looks like. And then we're starting to get calls too on the last side of people that are thinking opportunistically, how to engage with customers, how to build those relationships further, through this with your customers, and how can you take advantage of competitors? When was the last time you talked to your landlord? Can you restructure, lease or vendor contracts or those types of things? And obviously, M&A, making acquisitions, can be a little bit opportunistic, and there's some uncertainty there too. But anyway, just wanted to leave you with some of that in terms of how our good management teams are thinking about their business in the way that they're navigating these strange times. And on the next slide, again, there's capital out there for those who need it, for emergency, for strategically, who are others who are thinking ahead, where maybe they want to take some chips off the table and partner with the group who can take them to the next level. Obviously, banks are lending, but as you would imagine, as Jim mentioned, just in terms of underwriting, trying to get the credit committee, what the COVID period looked like, what it's going to look like moving forward. So banks are lending, but it's harder to get through credit committee, and they're going to price in that risk. So we're seeing prices go up in terms of on more traditional debt. Obviously, junior debt's out there. PE is really driving the bottom three. First, which is mezzanine capital. This is just a little bit more expensive debt than senior debt because there's no collateral. So you're looking at somewhere between probably 10 and 14% current pay. Usually there's some sort of PIK interest or paid in kind interest in there. Typically warrants, maybe board observation rights, but these are private equity groups who, it's typically cheaper than equity capital, but they want to loan you money and kind of help you get to the next level. And then typically they get refinanced out when maybe you want to make an acquisition or open a new facility, and your bank lender won't do it. And then Jim talked some about kind of preferred and structured equity. We're seeing a lot of creativity here in terms of not the traditional LBO buyouts, but more of, hey, how can we help? Maybe we'll take a majority, 51% or whatever it is, but we want to be in there to help you. And then lastly, we're seeing firms be more opportunistic, saying, hey, traditionally we've been, we take control, but we'll do debt. We'll do maybe a minority position because maybe they're not comfortable in terms of underwriting. So, making a smaller investment, they feel better about it. Maybe it's a way for them to get their foot in the door, board seats, that type of stuff. But generally speaking, friendlier capital these days with private equity groups, because we've seen a lot of groups spinning out of bigger firms, and all these. There's 8,000 firms out there just in these three strategies. So you can imagine they're all trying to be competitive with one another, and maybe they were a big firm, they're a smaller firm. So we're seeing a lot of flexibility in trying to be competitive, trying to win mandates and those things. And we're going to continue to see a demand. We talk to these folks all the time, and they're looking at deals, and they're trying to get comfortable with, they've got portfolio companies and potential new investments where, they can get their foot in the door with a good management team and move forward.
I just want to take a time to thank Michael and Jim for jumping on, sharing their experience in the market, giving us a little optimism for what's out there, but also some insights as to what people can improve on now to get ready for going to market. So thank you, Michael and Jim.
Thanks, Frank.
Thanks, Frank.
So probably everyone has NOLs coming out of their ears right now. I know I do. But in case you haven't heard enough, just going to talk a little bit more about them today. So you've probably known the status of NOL carrybacks have changed a little bit over the past few years. Prior to 2017 tax reform, there was a 2-year mandatory NOL carryback provision unless you affirmatively waived out of it. Then 2017 tax reform comes along and says, no more NOL carrybacks. You can only carry NOLs forward. There's a couple exceptions, but generally that was the case. And then fast forward to a few months ago in March 2020, and we have the CARES Act, which says, oh, actually now you can have a 5-year carryback for NOLs generated in 18, 19, or 20. So over the past few years, we've gone from 2 to 0 and now to 5-year carryback period. Other NOL current developments are, because of this new provision of the CARES Act, IRS has had to figure out a way to get people the benefit that might be generated from an NOL carryback. So there's been frequent, not so much I would say in the past few weeks, but in the first few months of the CARES Act, there were many pieces of IRS guidance telling us what forms to file, how to file it, when to file it, to what number or address to file these things to. So there's just been a ton of IRS guidance about claiming any benefit attributable to the NOL carryback. Of course, the main ways are to file a Form 1139 if you're a corporation. That's the tentative refund claim form. Or, of course, you can file for a refund claim on an amended return. So before we get to the punchline of this presentation, I thought it's important to visit some of the basic rules about how NOLs interact with various types of transactions and sort of what the relationship is. So I'm just going to talk about the 4 most basic plain vanilla kinds of transactions we can have, knowing, of course, that there's many variations on transaction structures and so forth. But we don't have time for all that. So the first type of general basic transaction structure is a taxable stock acquisition. And NOLs, which are a tax attribute, what happens with those in a taxable stock transaction is that they stay with the target. Because nothing's changed about the target. The only thing that's changed in a stock transaction is who owns the target. So, of course, you still always have to apply the 382 rules, which say when you've had an ownership change, basically if the equity in the company is changed by more than 50%, the amount of NOLs you can use to offset post-ownership change taxable income will be limited. And the other 382 rule, which has always been around too, though, has said that you can use any amount of your NOLs to offset any amount of pre-ownership taxable income. So that's how the general NOL and the 382 rules work in a taxable stock transaction. When you have a taxable asset transaction, the NOLs and other tax attributes stay with the target. And because the target can still exist, often the seller liquidates the target, but it usually doesn't have to. The seller reaps the benefit with any leftover tax attributes from the target. The third type of basic transaction is a tax-free stock transaction. The NOL rules are the same as they would be in a taxable stock transaction. That is, the NOLs stay with the target. And if you have a 382 limitation, you just can't. You just have to be mindful that you can only use a certain amount of your NOL to offset post-ownership change income, but you can use as much NOL as you want to offset as much pre-ownership change taxable income as possible. And then you have the tax-free asset transactions, and the rules here with respect to NOLs are not like those with taxable asset transactions, because through a specific Internal Revenue Code provision 381 says in certain types of tax-free asset deals, And those would be your typical basic statutory mergers, what we call a C or a D type of reorg. 381 says that the acquirer does get to inherit the target's attributes. You still would have your basic 382 limitations if they're applicable, but you can see by sort of describing these 4 transactions, which party, the buyer, the target, the seller, gets to reap the benefit of an NOL of the target. So now that hopefully you've seen what the relationship is between NOLs and the type of transaction and the various types of transactions, now we come more to the punchline. And that is, well, what's the practical aspect of that concept in the context of M&A? Well, one way that this concept is addressed practically is through the covenants in the relevant agreement, whether it's the asset purchase agreement or stock purchase agreement. And just in general, covenants in any agreement are things that dictate what each party can do, has to do, can't do, and so forth. It describes certain actions. And so most, if not every agreement will have a tax covenant. And as you might imagine, the tax covenant will dictate which actions the buyer and which actions the seller can take regarding the tax life or the tax history or profile of the target entity. So for instance, a tax covenant might say, target is precluded from filing refund claims with respect to pre-ownership change taxable income. That is, only the buyer can do that. Or it might say the reverse. Notably, tax covenants are a negotiated part of a transaction. They're not set by law. So it's just, however important that provision is to the particular party, given the particular tax landscape, given their particular NOL situation. So after 2017, when tax reform eliminated the NOL carryback provision, believe it or not, sometimes the tax covenants were silent as to which party, the buyer or the seller, depending on the type of transaction, could obtain a tax benefit for pre-closing tax periods of the target. Because people thought, well, we don't have the NOL carryback anymore. It's really not important. And so there are either provisions that were silent about that, or people didn't really pay attention to it. And so if that provision was in some sort of boilerplate document that the parties were working with, the seller may have looked at it and was like, that's fine, I don't care if it benefits the buyer because there's nothing that can be done anyway. So up until a couple months ago, those provisions for the past couple of years have been largely ignored. Well, fast forward to the CARES Act, when we now care about NOL carryback provisions again, and suddenly those tax covenants are getting back into focus. And some examples, what they might say are like, only the seller can file the amended returns or claim a benefit, only the buyer can. You may have a provision that says the parties have to cooperate in filing a refund claim with respect to an NOL carryback, and the parties get to share in the refund generated by that. It might say which party has to initiate the refund claim and so forth. There's many, many possibilities of what the covenants can say. So, but it's important because we now have a situation that may have been ignored in the negotiation phase of a transaction, and which really is coming home to roost now. The other reason why this is super important and beneficial is because the NOL carryback, since it's 5 years, the NOL generated in 18, 19, or 20 could be carried back to 13, 14, or 15, the years in which the corporate tax rate was 35%. So if you're able to offset taxable income at 35% rates, your NOL is being put to better use than if you're choosing, or if you have to carry it forward and potentially apply to 21% rates. So to rewrap, this present that we've been given, we have this new 5-year NOL carryback provision for NOLs generating 18, 19, or 20. We have lots and lots of rules and FAQs and revenue procedures and notices telling us the procedures and the timing, the deadlines for claiming refunds attributable to an NOL carryback. We know that if we can carry back an NOL to 13, 14, or 15, or 16 year, it generates a bigger benefit to us than if we are in a position where we have to use the target's NOL in a carry forward year. We also hopefully know that who gets the benefit of an NOL, whether it's the buyer or the seller, depends on what the structure of the transaction was, whether it's taxable, tax-free, asset, or stock deal. And really the most important thing is you got to go look, if you are a company or you represented a company that had a transaction in the past couple of years, definitely go back and look at the tax covenants in your M&A agreement and see and cross your fingers that you are the party that gets to reap the benefit from NOL carryback claims. And of course, you also have to cross your fingers that if you are the beneficiary of that provision, that there's there was taxable income in those carryback years to offset. So that's my 2 cents about NOLs. If you have any questions, my contact information is on these slides. Thank you.
All right. Thank you, Amy. I appreciate it. So I'll go pretty quickly here. And if you guys have any questions, feel free to drop them into the Q&A box, and we'll try to address them as I wrap up these slides. So for those of you who have heard over the last couple months, as part of the CARES Act, the PPP loan regime was implemented with starting off as a very, very, very rocky start. If you may have noticed in headlines or speaking with your advisor, there was a lot of lack of guidance when it first kicked off. And by piecemeal over the last few months, each week, it seems like the Treasury and SBA have loosened and made the use of the funds a lot more flexible after some pretty rigid requirements and a lot of uncertainty that was really on that horizon of how do we use the funds, and what if we're shut down? I have a dental practice and I'm closed for at least a month or so. How do I use these funds? Is it okay if I start at week 5 of paying folks? There were just so many unanswered questions where everyone was seeking some guidance to apply the rules in the way that they were intended. And so last week, legislation was passed and guidance was given that loosened the use of the funds to from 75% payroll to 60% for full forgiveness. And note that the non-payroll costs of that 25% previously and 40% previously isn't that you have to use your funds for that for 40% non-payroll. It's up to 40% may be used for non-payroll costs. So you need to spend at least 60% of your loan on the payroll cost, eligible payroll costs for full forgiveness. So like I mentioned earlier, the rules were made a lot more flexible with that act that changed the cover period from 8 weeks previously as passed with the CARES Act to 24 weeks for the cover period. And then also the testing date for the employment levels was pushed down the road to December 31st to June 30th. So that's been a really, really welcome law and change from a lot of businesses out there that were having trouble opening right away when I think we thought the pandemic would open up the doors by Easter as originally announced. And so I think that wasn't the case. And so we needed some more flexibility there. And also there was a provision in the CARES Act where you can now defer your payroll taxes, your Social Security taxes that are due for 2019 payroll until about 50% due at December 31st of 2021, and then another 50% December 31st of 2022. Not a huge benefit because you still need to pay those payroll taxes, but it's a good timing play where you can hold on to some of that cash for a brief time period. And also for the term, if the loan was not forgiven for the PPP loan, there was a term of a 2-year repayment period as part of that CARES Act. And so that has also been increased because I think Congress saw that it takes a while to recover for some folks, and coming up with cash to make those payments earlier on is going to be rather challenging. So they extended that term to 5 years for any loans taken out after June 5th. If you received your money before then and it's not forgiven and it turns into a loan, well, you got to work with your banker to make sure that loan term is changed to 5 years rather than 2. There is some money left in the hopper right now that you can potentially apply for. Note the due date for application is June 30th, 2020. And so that's about a week from today. So if you're still looking to obtain some of these funds to help cash flow your payroll right now, really, that's a great source of funding at this point in time. And so there's also some more guidance noted below for health insurance, retirement plan contributions that a lot of folks had questions on. And so I'll let you go ahead and take a look at those as time allows when you get the slide deck. And then also with the Flexibility Act, there was an easy application that was released for a number of types of borrowers where the original application seemed pretty darn lengthy and complex. And so SBA and Treasury came out with an alternative if you qualify, where you need to meet one of these 3 criteria. So for some of those, say, self-employed individuals like a real estate agent or someone with a side business, there's eligibility there for those folks if they don't have any employees to qualify for it. Also, for businesses that did not reduce the salaries or wages by of their employees by more than 25%, and did not reduce the number of employees or the number of hours of their employees between that covered period, you could potentially use that easy application. I don't think many folks will fit in that category. I think most will be in that first and third. And that third one is you've experienced reductions in business activity as a result of the health directives related to COVID, as compared to February 15th. So essentially before the pandemic was announced and really started. And they did not reduce salary or wages of their employees by more than 25% during the covered period. And the question I've received a number of times is, okay, well, if I've reduced my staff, am I exempt or not allowed to use that last qualification? Well, they really refer to reducing the annual wages. And so if you keep their hourly rate the same and they're back on the payroll, I think that we're really waiting for more guidance there, but I'm relatively certain that there's going to be some flexibility with that last qualification. So go ahead and head to the next slide, Amy. All right. And so another benefit for the legislation being passed was that 8-week to 24-week period. And so now we're allowed a much larger amount of eligible payroll costs to be considered for forgiveness from what was noted as $15,000 previously for employees to up to $46,000 during that covered period. So really, it comes down to, okay, we have a lot of payroll to absorb that PPP loan, and now we really don't need to mess with the non-payroll costs such as rent, interest, and utilities. And so if you really need to fill the buckets, I think that rent would probably be an easy one to get. Just trying to make that application streamlined with your lender who provided the PPP loan in the first place is going to be the best course of action to make this as painless as possible, because it's been a challenge for I think a lot of businesses wrapping their arms around this and tracking expenses and so forth. So I think your main sources of the forgiveness are really going to be payroll and I think rent. And if you really need to reach in those other buckets, that interest and those utilities as well. And so for any of those owners of S corporation, C corporation, partnerships, closely held entities, so you're not able to get that windfall of the $46,000 over that period. You're still capped at that lesser of $20,000, which is the $100,000 annualized over 2.5 months, or your 2019 compensation, whichever is lower for for that time period. So there are some different caps there for the owners of the business. So just be aware of those. And some other news that came out, I think Thursday or Friday of last week, the SBA Treasury will disclose the names, addresses, zip codes, business classifications and types of any of those loans for $150,000 to $10 million. So just be aware, if you receive PPP loan, it's not going to be disclosed how much you received, but that information will be made public as of the current rules that are out there today. I know that there's a lot of talking in Congress and with other parties to try to keep that confidential, obviously, but just note that that is the current rule as of today. All right. And so EIDL loans, a number of folks receive those advances. So just know that those advances are deducted from your forgiveness calculation. And so along with the advances, you may receive an email or notification from SBA that you're eligible for an EIDL loan. Check with your advisor, your banker, attorney. If you receive that and you're considering it, there's a lot of strings attached and a lot of requirements potentially for you to abide by when you have those dollars in your bank account. You know, these loans have been around for a long time. They've been mostly utilized by businesses in some of those hurricane-stricken areas or tornadoes and so forth. So it's not something that's new, but it's something that has a lot of strings attached to it. So just be aware of that and let your advisor know if you're considering taking out that EIDL loan. So that is it. I appreciate everybody's time, and Frank, I'll kick it over to you to wrap it up.
Sure. So thank you to our presenters. Certainly evolving topic. Feel free to reach out to any one of us and we'll get you in touch with the person who can answer your question. So thank you again for joining. Have a great rest of your week.
Awesome. Well, thank you all so much. Thank you to our presenters and have a great day, guys.